Good morning. Can you hear me? I just sent an email out to the class. However, I do expect students to know how to find me at 9 o'clock a.m. on Friday morning. I'm just repeating myself. 9 a.m. Fridays. We are here. You can find the feed in the playlist. And if you have any trouble with that, let me know. But after today, I'm not going to send a link unless there's a problem. I won't be sending a link. Okay, so you need to find it. Just like you would have to find your classroom. So half of the people are here, which is good. How do I sound? You hear me? Clearly? Today we're going to pick up where we left off and hopefully finish the notes today. Begin the review exercises, and then I will post some exercises to review this portion, which I will refer to as the first unit or the first module. I've used number 1 in all of the documents to illustrate where we are. Yes. So you'll see the names are always like 1.1, 1.2, and then when we get to the second unit, I will send you those documents, and they will be enumerated with 2s. All right. So I have to report asistencia in the class, and you are supposed to be meeting in the class, but I did tell you, you really can't make it. It's okay, you have the video to watch. If anything goes wrong with the video, there's not much I can do. That rarely happens, but it has happened where the recording doesn't go through, or something happens. So you'll have to contact your classmates or myself if you can't get the help you need. But otherwise, the videos will be stored in YouTube, and you should review them. I will also put in YouTube, I will put when I post assignments on Energy. I think that's the easiest. And because people are emailing me asking me if I was doing it, it seems a little bit confusing. Our students are not sure. So I put in the video, sending you back to the video, rather than sending you email me, and maybe asking me some questions. It's obvious you need that information. Okay, so I have to take care of asistencia. If you have dropped the course, or you're thinking of dropping, or you know someone who's dropped the course, just for my help, you can email me, or let me know if you're no longer in the course. I will send an email out to see if anyone is no longer in the course, and when they drop, because I need to report that information. All right, so we left off. I showed you how to use the NPV formula for mixed cash flows, and this is just to wrap up what I said. In general, for a finite number, so for a set number of mixed cash flows, so I couldn't say infinite cash flows in this case, we would use this formula. Okay. Now, if there are many cash flows, this can get tedious, right? Even though we do have our calculator to facilitate calculations, it can get tedious to be typing everything. So if there's a faster way to do things, why don't we use it? Why don't we see if there is? In fact, we learned in high school that if the denominator is the same, or sorry, the bracketed term here is the same, with a increasing series in the exponents, and then the top is the same, there's a particular formula that simplifies this expression. Okay, so that goes under series, simplifications of series. I don't know what you call them. So you're going to see something that looks familiar, and I'm going to show you. So if you have some sort of pattern, we're going to have a formula, and if there's infinite cash flow, so if continue forever. For example, if we were to try and value stock, the first approach is to make some assumptions about what future dividends are going to be, and if you make them level or the same, that pattern you would have to imagine either if it's the same or if there's a pattern of growth through time. Because corporations are not, because corporations are owned by shareholders who vote on boards and boards who hire executives, presumably this type of business can exist indefinitely, forever. Shares of ownership can be passed down to offspring, children, through generations, or they can be sold to other owners. So presumably a firm that is a corporation, it can exist forever. So in that sense, we could have infinite cash flows, future cash flows, that accrue to stockholders in the form of dividends, is usually how we consider it. So dividends are the cash flows or the payout to shareholders that are, they're not a commitment, they are a share of the profits that go to stockholders. And that's a decision that's made by the executive, how in terms of how it has to be done, it has to be done. So these cash flows could be indefinite in that case. Okay. So that's going to be my primary example for showing or demonstrating how the formula works. All right, let me see if you have comments. Remembering that you guys can private message me by mail, by text. Well, the audio's back. Okay, let me fix that. Now, after 10 minutes, you're telling me? Okay, let's see.
It's not recognizing my microphone. Hold on. How's that? It's funny. It has a different name. Not sure. All right, so I think I've set it up. Let me know how that sounds. I'm not sure what happened, but must be some sort of update I need, or there's been an update because I don't recognize, the computer doesn't recognize the microphone. I have to set it up. All right, so I will repeat. So this is a summary formula of what this is a summary page, of what we discussed, and it says that for an for a finite number of mixed cash flows, this would be your formula. Notice that the subscript changes, so that means these cash flows are different. However, the denominator is the same, but the exponent increases. And I mentioned that if there's a certain pattern in the numerator, if the cash flows in the numerator are the same or they're related in a constant way, we have a formula that we learned in high school of how to simplify this expression. So I'm going to take advantage of that in the case that we have a problem with level cash flows. Also, there's a simplification in the case that that cash flows are infinite. So cash flows that go on forever are possible. And there's two examples I'm going to use. One is the British Consul bond that pays cash flows forever, pays interest on the debt or on the bond forever. And there's also stock. Okay, so shareholders who own stock, they are the decision makers of who ends up on the board of directors, and the board of directors are the ones in charge with hiring the executives, and the executives are the ones who decide on dividend payout, if there was enough profit, or given long-term strategy, whether a dividend will be paid to shareholders. In that case, shareholders can anticipate those future earnings, and they can use them. So prospective shareholders, people looking at buying stock, can consider the value of the stock dependent on those future earnings. So they make a number of assumptions to do that, and we'll talk about that, okay? So those are the two cases, infinite cash flows and level cash flows have a simplifying formula for this, because otherwise, how are you going to enter this into your calculator like we learned? How are you going to enter this if you have infinite cash flows? You're not going to sit there forever, right? Entering cash flows. All right. So that's what I said. So here's the example of a bond that pays $100 per year forever. This is a British Consul bond. This is a specific type of bond sold in Britain. And it has been stated with a yield to maturity of 5%. Now the thing about bonds are what? You tell me. You should know what a bond is. So what's a simple way to describe what a bond is? So corporations and governments, they issue bonds or issue debt. It means that they're going to borrow money, but it's a very specific contract that they offer. The contract is known as an indenture. And these are from the governments, all levels of government, and corporations. Okay. Or firms can issue debt. So the bond contract stipulates the payments and the yield or the interest rate implicit for the bond. So in terms of our timeline, here it is. It looks very familiar, right? It looks like what we've been doing so far, except the $100 is the same and represents, in terms of our formula, it represents a cash flow. And for our calculator now, we're going to refer to this in our calculator as a payment. Okay, so we're going to move from using the CF keys for cash flows. We're going to move, because the payment is the same, now I want you to use the time value of money keys. And we're going to see, since this is level, this represents a payment. And on your calculator, that's represented by PMT. Okay, so these are all the same. When they're the same, we can use time value of money. So what this says is that the bond promises to pay $100 a year, and the key word to do things differently is forever. So that's going to, in this case, I'm going to show you a faster way. We don't have to use the TVM keys because this says forever. I'm going to show you a faster way, a formula. I'm going to say not now. I'm going to specify that we use TVM keys for payments. Or constant. I'll use the word constant. Level is a weird word for constant cash flows. And I'm going to motivate the formula. I'm going to describe where the formula comes from. All right. So you have to think about this. This acts like the interest rate on the bond, right? This is what it is. So that's the interest rate on the debt. And this amount that we're trying to sort out, so this is how much was borrowed by the entity from the bondholder. This amount at 5%, that amount goes to the bondholder. Right? Everybody agrees with this expression. So whatever the amount is, it's like a balance. It's like a pot of money, right? It's the principal amount or the present value amount. And that amount will go into a fund that pays 5% to the bondholder, and the money gets used by government or corporations to do whatever else. But it should be the case that at least 5% of that deposit in reserve should pay the bondholder $100. Does that make sense? And this is forever, so this is exactly what you're going to get. You're going to get $100 if you hold that bond, which represents 5% of the deposit or the loan. So the bondholder loans this amount and is promised $100. So this links all the variables. So if this links all the variables, what should be the formula to derive the PV, the present value amount? So reiterating, this is like the rate of return or interest rate I'll wait for you. I need you to have your aha moment. Somebody tell me. So what would PV be? If this is just a mathematical expression, how would you solve for PV? Thank you for your responses, however, they are incorrect. Come on, keep trying. This is multiplication here. Keep trying. I appreciate some people are thinking this through and they'll never forget this as a result. Thank you. Paola's got it. Okay, so maybe some of you also did. So if I solve this mathematically, it's just that. And what do you get? Let's solve this and then we'll talk about it. All right, so you got an answer. Okay, let's talk about, some of you are having questions, which is great. So you probably learned this formula before, but you never thought it through. It's possible that you've seen this and you work with it because you were in 3106, so you should have seen this before. So what does it mean? This is an example of the perpetuity formula that looks like I think that's how I wrote it on the formula sheet. All you need to know to solve this problem, that sounds overwhelming, right? $100 per year forever, given a yield to maturity of 5%. So what you're thinking is, don't I have to put 100 in here? So it's forever, but initially I would have to put to solve this, I would put a 0 here to find the value, right? That's how we use the mixed cash flow formula, and then 100 everywhere, and then this would go on forever. So that would be a problem because I'd have to sit forever entering $100, and I don't have forever to waste doing that. I have a life to live. So rather than do that, I use this understanding that the amount that's being deposited from my payment is like a reserve for the government or corporation, where they promise to pay me 5% of the balance, which ends up being $100 forever. And they use any kinds of returns, they make more than the 5%, they use that for their operations, however they choose. But they promise me that whatever happens, I'm going to get $100 forever. And okay, so that's mind-blowing, and then on top of it, it's only worth $2,000. Now, how can that be? Let's look at this. First of all, do you agree with my formula? Anyone disagree with that formula or have any questions? I put an X in here for multiplication, but I won't be putting that. I usually ignore the multiplication and just put values side by side, right? And you should be fine with that. But I put it in this case just to avoid confusion, so I usually put a dot, say. So you agree with this? Who agrees with this? That's what links the variables together. The 5% is a return on the investment. It's seen as an investment, right? Because I'm loaning the money and I expect a return. This is forever, so this is that ongoing relationship. So I can figure out what that present value should have been. And it's this. So nobody agrees? Everybody okay with this formula? This is a relationship between the variables. This is a formula which represent, the values of the question. So the bond costs $2,000. I'm going to get to that next. First, I need you to agree with this. Can you agree with this statement? Okay, so some people agree. So you agree with this statement, and that means that the bond costs $2,000. That's what it's worth. It's worth $2,000 to get $100 forever. Now, how can $100 forever be only worth $2,000? Shouldn't it be worth an infinite amount of money? Does anybody have a simple answer to tell me why it's not worth infinity to get $100 forever? Not inflation, but you're getting closer. It's not inflation. I haven't mentioned inflation, and I will talk about inflation, but there's another 3-letter term that is the answer. Kind of. The expectancy of the bondholder. The simple answer is a 3-letter answer. The answer is a 3-letter answer that begins with T. V, M. It's the time value of money. Because $100 today, if I got it today, would be worth $100, but $100 received next year is not worth $100 today. Right? Time value of money. The fact is, $100 in the future is not worth $100 today. So let's see. What am I talking about? Remember this. I'm on page 35. You guys are going to learn this once and for all, because I know you learned this before, but you need to learn it once and for all because you are in 4th or 5th year or 6th year of your program. You need to know this. Time value of money is the reason why. Because $100 next period is only worth $95.23 today. I use the 5% because I'm thinking, remember the example of the hotel. I have to compare everything against the 5% because I've decided in advance that without saying it, the 5% is the value at which I will trade off $1 today for $1 tomorrow. Okay, I would have to be promised if I was to loan $1 or invest or save $1, then I expect 5% return. And I find people to make the same deal with that 5%. They're willing to pay 5% later to receive $1 today. So, that means for $100, that's worth $95.23 today. $100 in 2 years is worth $90.70. $100 in 3 years at the end of the year is worth $86.38. So what happens? What happens is eventually I'm just adding in zeros because I'm going to get these in the future. I'm valuing them in today's dollars, right? I'm using time value of money, and I'm summing all of these. That's what the calculator would have done for me if I used the mixed cash flows. But eventually, at some point, I'm adding a bunch of zeros because of the erosion of the dollar. From the perspective of today, eventually I'm just adding a bunch of zeros. So that formula converges, we say it becomes a fixed number, a set number, as a result. Does that make sense? So this should make sense given the discussion of NPV and the fact that eventually these are all going down in value, right? They're getting smaller and smaller. This is smaller than the other one. They're all going down. So eventually we're just adding a bunch of zeros. Let me give you a moment to think about that. Does that make sense? So rather than enter this into the NPV formula, I found a faster way through thinking about exactly what's going on. I found a very simple formula. And the formula is known as the perpetuity formula. Anybody like this formula? No one's commenting. So that's the formula. This is for this example, and this is in general. So what are the requirements? So every formula has assumptions, okay? Every formula I give you has assumptions inherent. And for this formula, the situation needs to be cash flows forever, the cash flows are identical, and the interest rate we use is the same. This is like two major assumptions, and that the interest rate stays the same. I'm not sure your question, Juan. Asked, is there a time when TVM would be zero? What do you mean? You mean the present value be zero? Or at some point, these cash flows are going to be zero. That's what I mean. So then you have to add up whatever else is not zero to make the present value. You can check it. You can use Excel and build it up to see that these cash flows eventually become zero and when. Oh, I see. So I think you're asking, is there a time when the cash flows become zero? I don't know. No, there must be a way to figure it out, but it's not a set. It depends on the values, right? It depends on the relationship between the variables. If the yield is the same, we use this formula. If the yield changes, things are different. We're going to talk about an example where we're going to discuss an example where it doesn't become a final number, a constant price. Okay, we'll talk about that situation. But for this situation, cash flows are the same, the interest rate is the same, and the cash flows are forever. This is the formula you use. It's called the perpetuity formula. If the yield keeps getting smaller, one, that's not the situation we're in here. All right. let's see. So yes, I already discussed this, all right? So if you solve this problem, you find 2,000, and it's a little bit confusing because you say, how can $100 forever only be 2,000? Well, because the $100 from the viewpoint of today diminish in value over time. And so we're just adding zeros at some point. So it looks like maybe after, at least after, because these are about 100. So that would be 20. If they were all 100, it'd be 20 to make 2,000. So it has to be less than 20, right? Less than 20 years, they become zeros. No, that's not necessarily true. What am I saying? That doesn't make sense because they're very small amounts. No, you can't even say that. You cannot even say that. Because this could go on forever. We're adding pennies. We're just adding pennies and pennies. So I can't say right now with the tools we have how many years it takes for them to be adding zeros. So that doesn't make sense. But the point is, we use this relationship here to solve. All right. Okay. So if you get a situation on your, I'm showing you on the timeline. If the timeline looks like this, and this is what I expect to see in your timelines, if you're using a perpetuity, all you have to know is the first cash flow, because it's the same thing, you see. And then mention ... This goes forever. And so you need to have the terms are so same cash flows forever, same interest rate. So that's the opportunity cost, right? So these are the conditions for this formula to apply. What if I change things and say I don't have level cash flows, but they're growing at a level rate, as a constant rate? So here's my timeline. It's $100 in 1 year from now. You know what? Before I continue, let me add that one in. Very important is to tell you here that the first cash flow you can't use this formula unless that's true. Okay, so this formula assumes the first cash flow is 1 period from today, and I denote that as C1, because the next point, the cash flows are the same, C1 forever, and the interest rate is the same forever. It's like 4 assumptions built into this. Okay, so This is a different scenario. I'm going to look at the timeline first and then we'll read the exercise. So it's $100, but the $100 grow at 2%. Now to show growth, we use, just like in compounding, this is not exactly compounding, but we're using the idea of a factor. This is a growth factor, okay? We're going to use 1 plus G as the growth factor. And what happens is the growth factor has a higher exponent every period because it grows. Okay? Everybody okay with this timeline? Now this happens forever. Let's read the exercise. Just announce, this company, ABC Incorporated, just announced that it plans to grow steadily and will pay stockholders $100 per year per share starting next year, and then 2% more each year indefinitely. Given the required rate of return of 5%, what is the fair price of a share of stock? So, can we use the perpetuity formula for this? The difference is there's growth. Now maybe this aligns with what one was getting at. In this case, in terms of cash flows, the cash flows are increasing, right? They're getting higher and higher and higher. So now I can go back to the original question. So how can increasing cash flows be worth a finite number today? I mean, isn't that going to be infinity? So the $100, so this period, how much would it be? It would be, okay, so you're going to get, if you own this stock, you're going to get $100. What did I just do? I did that wrong. Let me erase that. You're going to get $100 at the end of this year, and you'll get 102 at the end of the second year, and well, what would the third one be? Let's figure that out. So I can put it with cents, so this becomes 104.04. All right, so they're increasing. So how does that work? Does that become a finite number over time, or how does that work? So there needs to be an adjustment, and I want you to get comfortable with adjusting your formulas. The original formula was okay. The fact that this is being multiplied and the exponent offsets the erosion of the dollar as a result of the interest rate or time value of money effect. So in fact, these rates offset each other, and it turns out that this is going to be your perpetuity with growth formula. So again, you should have seen this before, and hopefully now. So we don't want to put this into our calculator with CF keys, right? We will sit there forever doing that. So we don't want to do that. what we want to do is take advantage of the earlier formula that we understood and realize it needs an adjustment because the amounts are not 100 anymore. They're growing at a constant rate, and that rate offsets the erosion of the dollar due to time value of money effect. So that's what this does. So this is the formula, perpetuity formula. What are the terms of this formula? Let's write them down. I'll put them in blue. So first cash flow 1 period from today. You know what I'm going to do? I'm going to make this bigger. Let me do that again. The growth begins in the second period. Can you guys see that? Growth begins in the second period. And cash flows are forever. I the same. I and G the same forever. I'll say don't change. Okay, those are the terms for the formula. I don't know, maybe I'll make those bigger. Again, I'm stuck with this situation. How do I make them bigger? Okay, let me leave it like that so you can copy. And then, so this says, first cash flow is 1 period from today. Growth begins in the second period. Cash flows occur forever and I and G don't change. So there's two rates floating around. You have to be clear which is the interest and which is the growth rate of the cash flows. So I has many names. Someone asks, is that expected rate of return? I has many names, but it's the return, it's the opportunity cost of borrowing and lending in this example, or it's called the yield to maturity. So there's many names for I. So I can be called, take a screenshot because I'm going to move on. Oh, no, it's not making my picture level. So I is called here the required rate of return, right? It could be called the expected rate of return or the return on investment. In the examples we saw before, I was called the yield to maturity. We'll refer to I as the expected rate of return. As the cost of capital. So you'll see these terms throughout the course, and they all, depending on the situation, I gets a different name. So for bonds, it's yield to maturity. For stock, we're using required rate of return. For investments, we're going to use cost of capital. For projects, we're going to use cost of capital. And that's going to be the name for the value of the firm as well. So for now, I have not talked about inflation. I know some people are mentioning inflation. The I that we're working with has everything in it, okay? It's the I that I give you has everything in it. It accounts for inflation, in that market. It accounts for whatever. It's the nominal rate of interest. So anyway, we'll talk about that more later. Differentiating between the real rate and inflation rate. Okay? So let's use this formula now to solve this problem. Now, think about it critically. Should the price be more or less or the same than what we had before with the console bond? Right? Because it's $100. Okay, well, we'll use 2% here, so it's not a good comparison. I'm going to change something, and we'll see a comparison in a bit. All right, so is it going to be, it should be more, right? Because the denominator will be smaller. It should be more than if we just used, if there was no growth, right? Because the cash flows are growing. So let's see what I'm talking about. So you see here, the first cash flow is really $95.24 today. The second cash flow is really worth $92.52 today. The 100 is worth $89.87, and there's an erosion of the cash flows due to the time value of money. But I is slowed by G. Okay, it's not as dramatic as it was in the previous case. Why am I using 5? See, I did use 5 and I wrote 2 here, didn't I? Oh, 2 is the growth rate, right? No, that's fine. All right, so this is 5% is the used as the yield, or yield to maturity before, and now it's the required rate of return. Right. So when you solve this, we're going to use the formula with $100 payment, first payment, and then I is 0.05 and the growth is 0.02, and I always suggest simplifying the denominator before you enter this into your calculator. And when you enter that, you get the amount $3,333.33, which is more than the $2,000 when we did this problem without growth. In the console bond case where we use 5% as well. So notice, I'm using the same formulas for bonds as I am for stock in this case, in that special bond case. We're going to do more with bonds in a moment. All right, so this is the price. Now, can anybody see when this might blow up? In other words, when do cash flows not become zero? When would the present value be infinite? What would be the condition? So the question was, notice the price went up because we reduced the denominator by having growth in the cash flows that was level. That offset the erosion of the dollar, future dollars. So what would happen if the growth rate was 5%? What would happen? What would you get? The fact is that the G, right, this is the formula here. This is the formula and its condition. I has to exceed G. If it doesn't exceed G, for instance, if G is equal to 5, then this will just not exist. This will be a 0 under here, meaning this will be infinite. In other words, nobody could afford to pay an infinite amount of money, so it wouldn't exist. So this only is possible if the interest rate exceeds the growth rate. You need to remember that, okay? So this is how I've expressed the formula on the formula sheet. I've stipulated the condition, and I should add it to my list above as well. Okay, so I'll add it to the above conditions here. So what did we say? We said this formula only works if the first cash flow is 1 period from today, growth begins in the second period, cash flows are forever, I and G don't change, and finally, I must exceed G. Okay, so those are the terms for this formula. All right, so anybody not learned that before? So this is the variation on the perpetuity formula. This is known as the growing perpetuity formula, or the perpetuity with growth. So what happens is this, yes, you would, it would, in the formula, it would be a negative, but the point is, if I wasn't greater than G, you would get a negative in the formula, but the point is you shouldn't use the formula in that case. It's meaningless. Okay, the formula doesn't work. It's meaningless in this case. So you only apply this formula if I is greater than G. When a formula does not apply, you have to use first principles. You have to make a timeline and figure things out. But in this case, we know that if I is not greater than G, then this amount will explode. It'll become infinity. And because it's infinite, no one can afford to pay out infinite amount, so it doesn't exist. It's not real. It wouldn't exist in the market. All right, let's see. I've written it and summarized it here, and I've given you the formula. This is what you have on your formula sheets. So remember the terms. The first cash flow is 1 period from today. The growth starts in this. The growth takes place in the second period. So now you see G, and then it goes on forever. If you have cash flows and it looks something like this but not exact, you have to modify the formula. And we'll talk about how to do that. This is the problem we just did. And now I'm going to go one step further. We're going to get to annuities. So far for perpetuities, there are no special keys on the calculator to compute these amounts for perpetual cash flows. The only thing I can recommend, the only thing I'm going to point out to you is I'm going to start using this key that you have in your calculator to for the denominators. At some point you'll see this, but otherwise there's no special key. This is like flip. I call it the flip function. And I might have used it before. If simplification formulas don't apply, then you have to use the mixed cash flows formula with the timeline to figure things out. Okay, you'll see when that happens. You need to know the terms of the formulas to use them. So what do we do now? We're going to move into annuity. An annuity is, in the formula and the way that I'm going to describe it now, it's a perpetuity with future cash flows after a certain point deleted. Now you can think of that as just a fixed number of cash flows as well, but if you think about it the other way that I mentioned, we're deleting the cash flows that don't occur. You're going to understand the formula better. So here's an example. A car loan. A car loan is an annuity because it is a set number of payments. So if in this case 4 years or 48 months. Payments are the same, you see. And the interest rate that we're going to use on the loan is 1%. So see, I call it an interest rate here for the loan, but this is essentially our I for the formula. I also use the word effective to emphasize that the loan rate is the monthly rate and it compounds monthly. That's what effective means. That's important because for my formula, I need to use the payment that corresponds to the compounding interval. So since I've written this in months, and the payments are in months, I can do this. So let's see. So I'm going to use the payment, the payments are monthly, so in other words, I need the monthly rate compounding monthly, and I've been given it. So for several problems, I'm going to give it to you, and the next topic is going to be interest rate conversions, where you have to determine the right rate to use, and the rate to use is always the one that aligns with the compounding interval, or the payment interval. All right, so that's the timeline. It has payments, and they go for 48 months. What is the value of the loan? So it's been sorted out that to pay back how much you borrowed, it's going to be $100. You're told there's a 1% interest rate in there over the next 4 years. So now let's figure out how much this person borrowed. That's already there. So I'm going to describe the formula and then we're going to apply it, okay? Actually, you know what? Let's do it in our calculator first, and then I'll go back to the formula. So this is how we would enter this into our calculator. This is slide 46. So by now you should have your calculator in finance mode if you don't have the BA2+. And we're going to use now the TVM keys with payment. All right, so now annuities use TVM key with the payment function, or payment variable, or key. I will explain this formula in a second, but let's get the value just so we feel good that we've done something, accomplished something. So there's 48 periods, put that into N. The interest rate you're told is 1. Remember, we're in the calculator, we enter in percentage, so it's 1%. We skip PV because that's what we want to find. We tell the calculator we have to pay $100 for this loan. We're not interested in future value, we're interested in the PV, so we ask to compute PV, and this is the answer. Questions about the calculation, and then I'll talk about the formula. Okay, no comments. All right, let's go back to the formula. All right, so the formula is this one. Now, in a test situation, remember, I expect you to show me this. This gets you no points, but you might want to write it. And then you just show me your final answer. Okay, that's what I want you to write. Now, let's look at the formula for a minute. what do we recognize here? We recognize that this part of the formula is the perpetuity. And then there's this factor here. This is the adjustment factor. We're going to adjust for the fact that the future cash flows, you notice this? You should also notice this as a discount factor. So this is the perpetuity. And this is the discount factor. So what we're going to do is remove a perpetuity of cash flows that we don't pay. Okay, so this is the perpetuity part as though it was a perpetuity, but then, so that's why there's a 1 here. It says, so a perpetuity minus, then this gets multiplied by this, so you minus the perpetuity of cash flows in the future discounted to today. So I'm going to show you that in the diagram now, but that's where we're headed. So recognize it's a perpetuity with a adjustment term to remove perpetuity of cash flows that we don't pay, because it's an annuity, not a perpetuity. So here is, no, that's not it. I want to go back. Here is my derivation of the formula. So if it was a perpetuity, it would look like this, right? But the annuity stops here. So we are going to subtract these cash flows, and what are they? They're also a perpetuity, notice, because they're the same amount. But they start at time t, 1 period from t, the first cash flow happens. So this is also a perpetuity. Keep in mind, I don't expect you to derive this. However, this technique is useful in the future when I give you more complex problems. So if you learn the technique now, you'll save yourself some time. So this is a perpetuity in the future, but that is not the value today. I need to discount this amount, so this is my discount factor here, to today. And I take my perpetuity, I account for the fact that the perpetuity stops, I take off those future cash flows, and that's how I derive the formula for an annuity. And there it is. I take the first amount of the perpetuity minus the future perpetuity, and I simplify and get this formula. So you should have seen this before. This is the annuity formula, and maybe you saw it, it looked a little different, but I'll leave it like this because of the explanation I provided. This formula corresponds to this timeline here. First cash flow 1 period from today, level cash flows for a fixed amount of time. That's it. And the interest rate stays the same. So you can go through the same sort of thing where you outline first cash flow 1 period from now, cash flows are the same. Well, I can simplify that and say cash flows and I and this is only for a fixed number of periods, in this case t periods. Yes, Miguel, that's how we solve the problem in the calculator. So I need you to know the formula because you need to, for this test, you need to put the values in, and then you can need to put the values in the formula, write it on your answer sheet, and then you can put them in the calculator to get the answer. So, did I miss anything here? Yes, Juan, the calculator does that in a split second, and that's why I'm trying to get the students to use it, because there's no reason to waste time using NPV. It does it in less than a minute. All right? So this is the function the calculator has been programmed with. You just need to know when to use it. You should only use it in this timeline with first cash flow 1 period from today, cash flows in I the same throughout for T periods. And I see appreciation of the calculator building. Okay, so for the test, as I explained, you just have to write this with the numbers inside and your answer. This will not get you any points. So formula and result. Remembering to put a negative on this payment because you make the payment, but then but at the beginning you received a loan. So the present value at time 0 would be this loan of almost $4,000. Okay, so you got it? What's next? What do you think is next? Well, you can look ahead to see what's next. Let's see. Let's look at this exercise and then I'll go back to the formulas. I think it works better. So here is an annuity, but there's a twist here. So again, if the cash flows are not exactly as specified to use the formulas, you need to make an adjustment to the formula. Okay, before I do this, let's take a 5-minute break. I'll go make some tea. Let's take a 5-minute break and you can write me if you have any question. Let's take a break and resume closer to 10:30, okay? All right, I'm back. I am back. Hopefully you're back. All right, so what I do next is probably the last topic. Let's see how far we get. Well, annuities, because we're going to do annuities due, and then annuities with growth. And so you will have all the material you need to solve the problems I gave you. So for next week, I'll be sending a new set of problems. I should probably send those today. So for those students who finish the problems assigned, you can read through the new documents. All right. So what about this timeline? Whoops. This timeline. This timeline corresponds to this problem with cash flows of 1,200 occurring at the end of every period, but beginning today. So this is like the end of period 0 or today. How does that change things? It changes things because we have this cash flow here, so we could just use the old formula, or the original formula I just taught you, the annuity formula, with the remaining cash flows where the first one happens today. So I have to take account of first, there's a cash flow today. This is different. And then, because of that, the cash flows end early. So you basically have a shift in cash flows. The cash flows shift. Five cash flows shifted to today. This is an example of what we call an annuity due, or an annuity immediate, or annuity upfront. Those are all the same. So this would happen if you leased or rented a space. You would be paying that rent before the month starts. Okay? So for instance, you sign a 5-year lease to rent out your office space. You're renting it to someone, in this case a dentist, for $1,200 per month to be received at the beginning of every month for 5 years. The effective monthly interest rate you agreed to is 1%. So it's 1%, and it's going to take place for 5 times 12, 60 months. So we need to make that calculation first. The timing is monthly payments, and so I've drawn this with this timeline with months noted. So what we can do, does anybody know the fastest way to deal with this problem? I'm going to show you 3 ways, but what's the fastest? If you see the screen as blurry, or you don't see what I'm typing or writing, refresh your page. So no one knows the fast way? Well, the fastest way to deal with this is switch your calculator to begin mode. That's described here in slide, I'm going to explain all these slides, but let's start with slide 53. Here is the formula I described in words earlier. This is the annuity formula with the payments of $1,200, the interest rate of 1%, one less cash flow for the annuity because I pay one up front. So this is how I've adjusted the annuity formula. So to enter that the fastest way, convert your calculator to begin mode. You do that by hitting, remember, second, begin, second, set. And now enter the values as you would the regular annuity formula. And the calculator will make the adjustment for you. So that means there's 60 payments, the interest rate is 1, leave PV open, put the $1,200 as payment, as a positive, because you're receiving from the dentist, and you don't want FV, you want PV. Compute PV, and there's your answer. So it shows a negative 54,000. It means that you're giving away this value of $54,485 to get $1,200 for the next 60 months at 1% interest. We call that also the opportunity cost. Okay, so that's the value of doing that. So enter this and make sure you can get this number. Let me know. And then when you're done, return your calculator to end mode, or you'll be in trouble. Okay, so you got it. Make a note, put a sticky tab, use an asterisk, red marker, highlighter to remind yourself to return it to begin mode when you're done. Okay. So what you would do on a test if you had this problem and you chose this method of answering the problem is you would write this formula like this, and you would give me the answer. That's all you have to show me. So now I'm going to show you the other two ways to answer this, to get 54, 485, 51. And those are also ways, those are also techniques that are handy for use when you have problems that don't fit the timeline for the formulas precisely, okay? So we're going to practice those. So let's go back to the problem. So this was the problem, and this would be the version in the net present value formula. I guess it goes up to t minus 1 in this case because there's 60. This becomes 59. So it shifts all the cash flows up, and that's why I get this version of the formula. Okay? So this is the general formula. You can add it to your formula sheet. You should print that, the one I sent you. Okay, so you can add this to your formula sheet and maybe circle, highlight the important things that are changed, this extra term and this value here, just to remind yourself. So the first method would be to enter this annuity and then just add this one in. Okay, you could do that. So you enter this annuity, but don't forget you have to add this extra term in. So this annuity would be with 59 payments. You would get this value, and this is not 54,000 that we got first, initially. So that is adjusted by adding the 1,200 from the first payment. And then you get the same result. So notice I will not grade what you enter into the calculator. I'm going to grade the formula you give me and the final answer. So notice those are the same as the other method. Okay, so that is what I referred to as method 1. Using EndNote, I referred to as method 2. And then we get method 3. So let's see. Any questions about method 1, method 2, and before I get to method 3? In a test situation, I won't refer to which method to use. You just do whatever. Just do one of them. Make sure you do one of them. Why is the interest rate represented as 1? Because the interest rate in the problem is 1%, and because that's what we put into the calculator. The 1. We entered it as a percent, not a decimal. So that's good to point out, remembering in your calculator takes whole values, all right? You have to remember that. It's tricky. It gets trickier when we give more complex problems, but that's why we practice the easy ones first. And we develop the habit. All right, so you have method 1. Hopefully we know method 2 in begin mode. make sure your calculator is in N mode before we do method 3. Okay, looks like everybody's ready. So you should have the same answer calculating with method 1 as you do for method 2. And finally method 3. So what's method 3? Method 3, this is method 3. I should show you on the timeline. Let me show you on the timeline. I'm going to go back here to the timeline. So it's just another way of looking at this timeline. What if I see that, notice this timeline goes forward, but it also goes back. Everybody okay with that? So since the cash flows have been shifted forward, they're going to be worth more, right? Because $1 today is worth more than $1 next period. It's going to be worth more. If I use my calculator with 60 payments, with 60 payments, an interest rate of 1%, what do you get? Just use your calculator in the regular mode. What do you get? Give me the value in the chat. So for the regular annuity, with 60 payments, 1%, of 1200, 0 into FV, compute PV. Compute PV gives me the amount $53,946.05. Who got that? No one. Okay, try that. Try that again. I just want the regular annuity with 1% at 60 payments of 1,200 should give you this amount. Thank you for trying. Everyone, keep trying as you're going to learn when you try. In regular mode, regular annuity, in a regular annuity mode. So no, well, now I fixed your calculators. Regular annuity, make sure it's in N mode. Well, one is asking if I can look at the values entered. No. Unfortunately, there's no spreadsheet that I know of. If somebody else knows, they can let me know. Now, you can't see the values unless you hit, I did it the other day. How did I do it? I did, let me see. If you hit compute, it'll show you the values. So if you hit compute and compute, like the one, don't hit, no, see, if you mess it up, you'll get an error. But if you want to see if you've entered a value correctly, hit compute and the value. But you can't hit the ones that you didn't enter. It will end up computing FV, for instance. Right. Okay. So this is from the regular annuity. Now my question to you is, first of all, well, the first question was find it, get it. So this is the value. Now, where is that value? That is the issue. If you enter 60 payments at 1%, remember the first cash flow should be 1 period from the valuation. So that means the valuation should be here. This is very important to realize. Okay, I've kept repeating. For the formulas, the first cash flow the cash flows begin 1 period from the valuation or the price or the present value or the fair price. We call it different things. So this amount that you got, the 53, goes here 1 period before. That's in fact what you found. You found the price at time -1. So if you did this, you have to adjust. And the way to adjust, and this is how I talked about this at the end of the last class, this lump sum can be adjusted to be a value at time 0 by doing the adjustment, by making the adjustment. What would be the value of this at time 0? It has to be exactly what we got last time. The way you'll get it is by taking this amount and multiplying by an accumulation factor. So you would have to get 53,946.05 and accumulate for 1 period at 1%, and that will give you the answer you have in the other exercises of 94,000. what was it? Let me get it again. So 54,485, 51 is what you got before, and you will get it now as well. So let me repeat. What I did here was the regular annuity. I treat it like a regular annuity in N mode, and I entered 60 into N, 1 into interest, 1,200 into payment, 0 into FV, and I asked to compute PV, and I got this amount, but that's not the right answer because that's the answer, that's the value of those cash flows at time -1. The price, though, I need is at time 0. To get it, I need to adjust this amount by accumulating for one period at 1%, and that gives me the value. So that is method 3. Questions? Any of these methods is acceptable to me. I'm teaching you, I'm taking the opportunity to teach you how to work with these timelines when your formula, or how to adjust the formulas when the timelines don't match the simplification formulas that I give you. I don't think it'll work by adding the 1,200. That will put you over. You have to, it has to be a growth factor. So remember, there's the time value of money that affects cash flows at different points in time. They have a different valuation, okay? So let's repeat. So this is method, so method 1 was just to realize there's 59 payments plus 1 today. So use a regular annuity on the 59 and add 1 in. So if you like that, that's called method 1. Method 2 was to turn your calculator to begin mode, write this down for the purpose of a test, and then enter everything as though it was regular annuity, and you get your answer immediately. So this seems the fastest way, but I don't want you to forget to put your calculator back into N mode before you do any other exercises. And the third way, which is a technique that's useful for adjusting formulas for timelines that don't precisely match the formula, enter the cash flows, or the information, the data, as though it's a regular annuity. Recognize that this is the cash flow, this is the present value 1 period before the first cash flow today. So you need to adjust this to make it, put it in what we call like times $0. So adjust it, and there you go. So those are the 3 methods. I've given you in the exercises on the, what I call the annuity handout, you get to practice doing that, okay? And I haven't, again, provided a summary of the techniques. So that's for you to practice. First step is recognizing you have a problem. That the first cash flow is occurring today and not 1 period from now. All right. So those are the 3 methods. You'll get to practice with the handout. And I'm going to talk about bonds. Unless you have any other questions. So yes, the payments are at the beginning of the month. That's the difference. I just want to check. Where did I put? Okay. Ready? Okay, let's get back to bonds. So far, when we use the TVM keys, we've always used 4 variables and left one unused. Bonds with coupons use all the values of the third row of your calculator, okay? So I'm going to teach you about that, how to do that. We begin though with a simple case of 0 coupon bonds. These are pure discount bonds. That means that, so unlike the British Consul bond, these bonds promise to pay. So different from stock, right? Because stock, it's a decision, it's not a guarantee, and we just make assumptions to try and value the stock. In this case, the contract, the agreement for the bond stipulates the payment of the bond, the time, the duration of the bond, and implicit in that is the yield, meaning like these details will be outlined, and that gives a yield of 6%, okay? So if you loan money now or buy a bond, in other words, you get $1,000 in 5 years for the price that you pay. This has a 6% yield or implicit interest rate. So how can we figure that out? What is the price? Well, this is just a basic time value of money problem, right? $1,000 in 5 years. There are no payments. Just $1,000 in 5 years. So I'm going to use the original time value of money formula in this form. That will serve our purposes, right? Now maybe you've seen this before with different notation. I'm going to stick with the same formulas just to let you realize they're really just a couple of concepts we've actually covered here. So I just repeat using the same formula to avoid confusion. So notice we're solving a 0 coupon bond formula, determining the price where you're told the yield on this bond is 6%. So what is the fair price for that bond? So the future value would be 1,000, and the interest is 0.06. So that's 1.06 to the power of 5. So you could do this algebraically in your calculator, or let's use the TVM keys for that, right? So we're going to enter 5 into n, 6 into interest. Payments, PV is what we want, so we won't put anything there. And there's no payments. And we're not interested in the future value. Oh, sorry, we have the future value. So the future value is the 1,000. The other word for future value in the case of bonds, so you see, depending on the situation, there's different terminology used. This is also called the face value of the bond, which coincidentally has the same abbreviation or initials. So for this problem, you got this amount. Now, 747.26 is less than 1,000. That's why it's called discount. Okay, so to get $1,000, you only have to pay 747.26. So that's a discount where you're earning the prevailing interest rate of 6%. So as an investor, as a consumer, this is the interest rate you use because that is the rate at which you're willing to lend money. That's the price you expect for every dollar you invest. In this case, you're loaning money at 6%. You expect a premium of 6%, a return of 6%. All right. So notice how it all goes into your calculator and it comes out as a negative because that's what you pay now to get the 1,000 later. All right, so that's a discount bond. No coupon. So what's a coupon? A coupon is a term of a bond. It's possible to buy a bond that you don't have to wait for payment. So this makes it a little more like a stock in that you're getting intermediate payments. Right? So you're going to be getting money over time, but then at the end you get the principal back and some other payment. The structure of this then involves both an annuity component for the payments and the lump sum at the end, the face value, for the time value of money component. So there are two parts to this formula. So let's look at an example. You're told that there's a coupon bond, so this is going to be the rate. We have to learn how to interpret that. That's the rate of the coupon rate. Okay, so this is a coupon rate, different from the interest rate. Here's the coupon rate. The bond pays 1,000. So in this class, the face value of bonds will be 1,000. In reality, you can get a 5,000 face value bond. Bond. But yeah, we're going to just use 1,000 throughout. It's pretty standardized. Pretty standard contract. These variables change, but the terms are usually like this. So 6% coupon rate pays 1,000 in 5 years. That's the term to maturity, we call it. For the term of the bond. If bonds of comparable risk have a yield to maturity of 6%, now this is the yield. This is a different rate. This is like the I. What is the fair price for this bond? The coupon rate is determined, so this 6% represents 6% of the face value. So this is a formula that you should add to your formula sheet. Maybe have a section on bonds so that you can find the payment. The payment is always the coupon rate times the face value. So this means that it's $60 every period, even the last period. So you see, I've drawn the timeline here, and now you can tell there's two parts. There is this portion that is the annuity portion, and this portion that is the basic time value of money. This is a new problem. This is coupon bonds. So this is different from the one that we just did because there were no payments. So now, when you solve this in your calculator, you're going to enter into every single key. Ignore that for a second. Let's go here. All right, so let's enter this in our calculator and discuss the results, okay? So 5 goes into N, 6 goes into interest, nothing into PV because that's what we want. 60 goes into payment. Notice it's a positive because we're getting that if we own the bond. And 1,000 because we're going to get that. It's a positive because we own the bond. Compute PV, and what do you get? So you got it, right? So in your calculator, it'll tell you it's negative 1,000 because that's what you have to pay to get this deal. So now you have to sit back a moment and realize you pay 1,000 to get 1,000. What's going on? Well, you're not just getting 1,000, right? You're getting these payments of $60 every period. So in effect, the payments have paid you your interest. Okay, so this is the idea that the payments are making the interest payments for you over time. And so all that you have to get back is the principal invested, the 1,000, and then that's it. The bond is has matured. This is called a par value bond. And it is the case when the coupon rate equals the interest rate. You need to remember that because people like to assume, the questions in textbooks like to assume that you know that. And they just use the word par, okay? And you should know that. Questions? Okay, so these formulas take care of all the considerations of time value of money, and that's why we use them. Unfortunately, for the first test, some students forget all this. You can't just times 60 times 5 to get 300. That's not what's happening, right? Each amount has a different value through time, and the time value of money formula capture that. So what is the formula? Here it is. The formula is the annuity piece and the face value, or the time value of money piece with the face value. So it's common that students forget these two, but you guys won't, right? You're going to remember that those two make this formula. And you could punch this in your calculator. You can practice, you need to practice actually entering this into your calculator. Why don't we give that a shot? Let's take a moment to use your scientific keys on your calculator. So you don't forget how to do that. So to enter these into the calculator, what I would do is I would start inside the bracket, and I would say, I would begin with 1.06 y to the x 5. That's what I would do. And then tell my calculator to flip so that I have this entire term. Then I would change the sign to a negative and add in 1. Now I have the full bracket. Then I would multiply by 60 and divide by 0.06, and I would get my answer for the first part. Say equals and then store in 1. So let's just practice that. Did I miss anything? I'm going to try it on my calculator. So 1.06 to the power of 5. Okay, you have to say equals here. Equals. Then flip. Then change the sign, then add 1. Then times 60 divided by 0.06. Store 1. Okay, so you should get 252, 741, 8271, and the calculator will store all those decimal places for you. Then you have to get this side. This side would be 1.06 y to the x 5, and then equals, and then flip. And then multiply by 1,000 equals and store in number 2. And this would be 747,258,1,729. And to get the final answer, you have to recall 1 plus recall 2 equals. And you get 1,000. So practice that. I'll give you a minute or so. You're just practicing, right? Using your calculator. Obviously, you can use the TVM keys, but there might be some places where I'll expect you to enter these values to find partial, to do parts of a problem. You'll see. You'll see, trust me. I want you to be prepared for that. And you shouldn't round. Even though coincidentally it'll work here, you need to get into the habit of not rounding. Let me know when you're done. Let me know when you're done. Okay, so remember those skills. Take a screenshot if it's easier than writing what I wrote. This is how you use the storage keys efficiently. Of course, you can use the TVM keys, the best, but this is just a skill of manual entry that I want you to have. All right, so we learned about par bond. What about non-par bonds? So that will happen when there's a difference between the coupon rate and the interest rate or the yield. So what do you think the price will be in this case? Do you think the price will be more or less than 1,000? Now it's easy enough to enter into your calculator and change the payment to 30, but I want you to think for a moment what's going on. What changed was now you're going to get $30, not 60. So you're not getting the full interest rate of 6%. You're not getting the return on the investment. So you need to be compensated for that. So what you will be compensated with is the price being lower than 1,000. Good, some people got that. Okay, so let me say that again. Since these are now $30 and not 60 that you need every period to get the interest payment, you need to be compensated in the price, because that's the only other way you can get, you can benefit. Rather than paying 1,000 for that deal, to get 1,000, you're going to pay less than 1,000, and that way, when you get the 1,000, that's like a premium, that's a payment for lending money. All right? So that's what your calculator is going to sort out for you and tell you what that price should be. So the answer is less than 1,000. This is called a discount bond. We'll get to that in a second too. Oops. So the formula looks like this. Now I changed 30 is the payment, right? Interest rate is 6. And I have the second part, which is just the principal amount I get paid. So that's the face value of the bond, that's the yield, and that's the coupon. So there it is, it's less than 1,000. So because it's less than 1,000, it's called a discount. You get a discount on it. And it's because the coupon rate is lower than the interest rate. So the coupon payments don't pay you the interest completely. Let's try that in the time value of money keys. You should try and enter this manually too when you practice, okay? But let's try in the time value of money row of our calculators. And it's 5 into N, 6 into interest, 30 in payment, 1,000 in future value, and you ask for the PV, which will be a negative, the amount you pay. Notice that you use all the keys. So my recommendation is always to enter this information from left to right. So if I want to clear the TVM, right, second clear TVM, and I begin 5 years, interest was 6, and then the payment was 30, and I put 1,000 to be received in future value, and I compute PV. The negative tells me that that's what I have to pay to get those returns, to get those that lump sum of $1,030 every period for 5 years. All right. Finally, what if the coupon rate exceeds the interest rate? Now you're going to get more than $60 every period. Now you're going to get more than $60. So should the price be greater than 1,000 or less than 1,000? So the payment will be a 70, remember, because of this. The coupon rate times 1,000 gives us the payment. So in order to get $70 every period and 1,000 later, at 6%, that means that you're going to pay more than 1,000. So this is called a premium bond because you pay more. Putting these into our formula, we call this a premium bond. Remembering the cash flows payments are 70, the interest rate is 6, the time is 5, and then there's the lump sum at the end. So entering this into our calculator, we get, it is going to be a little more than 1,000. It's 1,042.12. So try that. Let me know when you're done. So this is all because the interest payments over time, or the coupon payments over time, exceed the interest or the yield stated on the bond. Again, you use all the keys. So after bonds are issued and sold for the first time, bondholders can trade bonds. Okay? And some things don't change. Okay? Can't change the payments of the bond or the term of the bond, but the interest rate, the implicit rate that we've been calculating or we've been using so far was 6%. That can change, right? That will change. So that's not a term of the bond. What is set is the coupon rate and the term of the bond, how long the bond takes to mature. So in situations where you're looking at a bond for sale, you get the conditions of the bond: 3% coupon rate. It promises $1,000 in 5 years, and the market determines the price. Okay, so this is what it's selling for currently, $854.55. So you can go ahead and figure out what the yield to maturity is, so you can compare it to other investment opportunities. You can decide if that's good enough for you. All right. So we're going to find a different variable. So far with bonds, all we've been calculating was the present value. Now we're going to calculate a different variable. So we need the formula, we need to know how to use our calculator, and we need to solve for interest now. So this is something new. This is the timeline. I have all this information, plus I have the price. $854.55, so that's what it's selling for, $854. So we can figure out what the yield to maturity at this point in time is on that bond. So let's set up the formula, because I always want to see the formula on a test. And this is how the formula will look. Don't forget both terms. This is the annuity piece with the $30 on the price. And then this is the basic time value of money discount formula for the $1,000 to be received in 5 years. All right, well, you have to be careful here. We're doing something different. To find the interest rate for this problem, the return on this investment, you need to be sure you have your signs right. You need to be sure you have the price as a negative and the payment and future value as, or face value as positives, okay? You need to make sure you've done that. Let me put it like this. Otherwise, it will not work. Now, if you didn't already, you're going to appreciate having this calculator to solve this, because it will be virtually impossible to solve this analytically. You won't be able to isolate I. Okay? You could solve this with Excel through estimation, choosing I's, and I think you might have done this in 3106, choosing different I's and plugging them in and iterating to the answer. Interpolation would help you find the answer, but so you don't have an analytical solution where you isolate for I. However, our calculator will do all that iteration for us. You just have to give it the variables. If you flip the signs, that would be fine too, as though you were selling the bond. So you would receive the payment at the beginning, and then you would pay out these that's fine too. The point is, though, that both of these have to be the same sign, payment and future value. So let me know if you get it, and we can continue. We still have some time. So what you're finding is the implicit interest rate in that trade, all right, which is not pre-specified. It's just at the beginning when a bond is sold, in the initial offer, or in the issue of the debt. That's how we refer to bonds issue or debt issue. The interest rate is, it can be calculated, but on the contract, on the indenture, just the terms and the coupons are stipulated. Very good. So you guys are getting it? So don't forget that you have to put those signs in correctly or it will not work. All right, some people are getting it. Why is this not going? Sometimes this works funny. All right. So we've solved for the value of the bond. We've solved for the price of the bond. We've solved for the yield to maturity on a bond after its initial sale and the resale value is given. Now let's use the same formula to solve for a different variable. Let's solve for the coupon rate. Here's the problem. This bond pays $1,000 in 5 years, currently sells for $900, and you're told that bonds of comparable risk have a yield to maturity of 8%. So this is the rate of return to be used on the bond, okay? So risk, when we talk about risk in bonds, it's possible that there will be a problem in paying or repaying the debt because maybe the company will have trouble. Now, government is not supposed to have trouble repaying debt, but we learned in Puerto Rico, because we do not issue money, we cannot here guarantee, well, we can, but in the government bonds that were issued over the last several years, decades, there was a problem in repayment of the bonds in 2015, which led to our current financial, what we would call economic crisis that we face. And however, bonds were committed, or the government was committed to repay, and these were supposed to be no risk bonds, but it turned out the government appeared to be less likely to pay bondholders, and that to attract bondholders to Puerto Rico debt, the interest rate or the implicit interest rate on the issue had to go up. So interest rates were going up on the bonds, and they made it even less likely for the government to be able to pay. So there was risk inherent in those government bonds. But essentially, government debt often, because of the ability of the government to issue money or through their central banks, I'm not going to get all into this, but basically government debt is less risky than corporate debt, okay? But there is a risk inherent, and here in this problem I'm telling you that the yield to maturity has to be 8% for this bond, right? For however the information has been tabulated, all the information available was used to determine this. So this is the timeline, and now I want to find the payment, the coupon payment. How will I do that? Using the same formula again. This is the large formula with the two parts. We have the annuity, and we have the basic time value of money lump sum amount at the end. Putting it all down, remembering to keep our signs balanced with a negative here and the two positives here. We find that the payment is $54.94. Now that's not the final answer. The final answer should be a coupon rate. Now remembering that the coupon payment is determined by this formula, right? Payment was equal to C times face value. So we could solve for the rate by calculating the face value divided by the payment, which is what I did. So the percentage rate, or you can also think of that as putting the decimal over 3 zeros. So that percentage rate turns out to be 5.495%. Yeah, Juan, you're going to have to do that. You're going to have to practice just doing it on your own. For the interest rate, you won't be able to solve that algebraically. So this interest rate, you will not be able to solve algebraically. There's no way. So you won't be able to isolate for I to solve this. You would have to use a computer or picking values in a systematic way. You could use Excel. But I'm not going to waste time on that since we have a calculator that does it for us. In terms of the other ones, trying to solve for these analytically, like this one you could solve. You would plug this into your calculator, this part and this part, and then just rearrange algebraically. You could practice on your own. The only one you're not going to be able to is the I, because the I is within these two bracketed terms. Make sure you can get the same answer. Okay, you're going to need that skill. Just like I did in the last exercise, use your storage keys, etc. right, I want to get to the last topic. We only have, well, actually, no, we're supposed to stop, aren't we? It's 10:02. All right, so let me stop here. I'm going to finish these notes next class, so I'll send you what you need for next class. Complete all those exercises I gave you. I gave you the solutions. So for next class, and I'll put it in YouTube as well. For next class, so I'll put a few problems in Connect, and you should also solve all the problems in the exercises I already gave you. I think you should be able to do all of them. Okay, and so those ones you don't have to hand in. This is for hand in. So you need to submit this one before the class. That will be due on Thursday night. This one's just for class review. Okay, so we'll review that in class. I'll answer your questions, and then we'll get to the new material. Any questions? No tiene que entregar nada except the Connect exercises. The reviews are for you, okay? Oh, you can't see what I wrote. There you go. So remembering, in a test situation for a problem like this one, I expect you to show me this formula and the answer. Actually, you should probably show, in this kind of a problem, you would show me all of this calculation. All right? So for a test, I want this, this, and this. For asistencia, just let me know if you're dropping the class, or you know someone who left the class, or I'm going to send an email anyway to everyone and see if everyone's still in the class. Just don't respond if you're in the class. Just let me know if you dropped the class. That will help me with the asistencia. All right? Okay, so bye for now. Thanks for your patience and for coming prepared and staying in tune or up, active, because I see you're solving problems. You can get up on Friday morning and work with us and then take a nap after if you're really exhausted. But come prepared and alert, and we'll make it to the first test. The first test will be on the. It's going to be on the, let me think, today is the 5, right? And then 12, the 19th, right? That's when I scheduled it, 19th. So we'll be very well prepared for that one. Have a good weekend, everyone. If you have a question, you can write it in the chat or text me or email me, all right? Bye for now.